The modern monetary system, a system designed to bring economic stability and growth, to make families happy. Or is it? Let's take a closer look at what lies behind the banking system and understand the quiet erosion of your wealth. Let's begin with the bank and its economic purpose, lending money to finance investment activities. However, lending should only occur when the investment has the potential to generate profit and repay the loan. If there is risk involved, the bank must charge an appropriate interest rate. There are two components that should make up the interest rate: the credit risk premium and the risk-free rate. Let's take a quick look at credit risk, which refers to the probability that the borrower might fail to repay the loan. In simple terms, the loan interest I must at least equal the default probability times the initial loan. For example, with a 20% default probability on a $100 loan, the expected loss is 20. This means the lender would need to charge at least $20 in interest. However, this calculation assumes that interest is always repaid in full, even in the event of a default. In reality, if a borrower defaults, the lender loses not only the principal, but also the interest payments. Therefore, the probability of losing interest must also be added to the risk factor. To visualize this, suppose 5 borrowers take out a $100 loan and one, so 20% of them, defaults. The lender incurs a $100 loss, which must be covered by the interest payments from the remaining 4 borrowers. If each only pays $20 in interest, the total interest collected is insufficient. To break even, the lender would instead need to charge a minimum of $25 in interest, so that the 4 paying borrowers collectively contribute at least $100 to cover the default. Summarized, the goal of credit risk is for the bank's overall returns to exceed the average cost of its funds, so that even if some loans default, the bank remains solvent. Now, let's have a look at the risk-free rate. The risk-free rate is determined by the interaction between the supply of credit and the demand for investment. It is simply added to the credit risk. While credit risk varies by individual, the risk-free rate is the same for everyone and is determined by the market itself. For example, when the demand for credit exceeds its supply, interest rates tend to rise. Higher rates increase the incentive for lender to provide funds as the expected returns on lending improve, while simultaneously discouraging borrowers due to a higher cost of capital. Conversely, when the supply of credit surpasses demand, interest rates decline, stimulating borrowing activity and moderating the incentive to lend. Through this self-adjusting mechanism, the interest rate equilibrates the market for loanable funds. Consequently, only the most productive investment projects are realized, thereby promoting an efficient allocation of resources and enhancing overall economic productivity. In today's monetary system, the central bank plays an important role, taking control over the market. Instead of letting interest rate adjust through market forces, central banks actively set policy rates by controlling the money supply, thus align market rates with their targets. The key idea is that as an economy grows, its money supply must expand to maintain price stability and employment. With a fixed money supply, growth and productivity would instead cause mild deflation, goods becoming cheaper as output rises, directly benefiting savers. Typically, policymakers aim for mild inflation. They achieve this by lowering interest rates significantly, thereby stimulating the economy and encouraging investment over saving. Initially, this creates price pressure in asset and commodity markets, which can later lead to consumer inflation if the resulting investment fail to enhance productivity. In other words, a currency's purchasing power erodes when credit is extended under unfavorable conditions, and the resulting losses, dispersed across the economy, are effectively offset by creating additional base money. However, This means that productivity gains are absorbed through monetary expansion rather than being reflected in lower prices or higher real wages, effectively transferring value from savers and workers to borrowers and asset holders. Before 1971, this process was constrained, as base money was backed by gold, each dollar corresponding to a fixed amount of it, limiting excessive monetary expansion. While both monetary systems have their advantages and disadvantages, modern monetary policy, if implemented correctly, could be beneficial. However, there are clear indications that wages have not grown in line with productivity since 1971. During the same period, income inequality has increased sharply, with the top 1% capturing a disproportionate share of economic gains compared to the bottom 50%. Although these developments may not be caused directly by modern monetary policy, it plays a significant role in shaping today's economic and especially political landscape. Under a gold standard, government spending is naturally constrained, because the central bank can only issue currency backed by a fixed amount of gold. This imposes fiscal discipline and limits the government's ability to run large deficits. In contrast, today's fiat monetary system allows governments to mask underlying fiscal weaknesses and encourages short-term political decision-making. Politicians can promise new programs or financial benefits to voters while hiding the long-term costs. One major issue is the uneven distribution of newly created money. Financial institutions benefit from transaction fees, cheap liquidity, and money expansion. They often operate with low equity and rely on speculative gains, knowing that potential losses may be covered by government bailouts. Similarly, corporations and investors with access to credit can borrow at low interest rates to expand operations or invest in financial assets, further increasing their wealth. Some even receive direct subsidies, giving them privileged access to newly created money. Households, by contrast, tend to lose the most, since they primarily hold cash in bank accounts. Although they should receive interest, in practice they often accept minimal or no returns. This happens largely because many people have limited awareness of financial happenings. This channel is dedicated to providing the necessary tools and information, exploring both current and historical economic context to help you build awareness and make better personal financial decisions. Make sure to subscribe so you don't miss any important content. We will start with this video, which provides an introduction by outlining various options for both preserving and growing wealth. The most accessible and reliable assets include stocks, bonds, and gold. Other honorable mentions are real estate, which is a strong option provided sufficient capital and time are available, cryptocurrencies, which remain relatively new and cannot yet be considered fully reliable, and silver, which in theory is similar to gold but has performed worse in the last 60 years. As a general rule, broad diversification across different asset classes is the best way to preserve long-term wealth while benefiting from global economic growth. To personalize your strategy, the first factor to consider is volatility. Depending on your risk tolerance and personal needs, you will need to adjust your portfolio accordingly. Higher long-term gains may require you to endure significant volatility, even years of negative performance. By looking at past performance data, we can better understand different asset classes and their relationship between returns and volatility. Starting from 1970, we first set the inflation index and the money supply as reference. Note that we're using a log scale to better visualize long-term performance. Every grid line represents a doubling of asset price. Next, we add the most relevant asset classes: short-term bonds, long-term bonds, gold, and stocks. we notice that gold has performed best over this specific time range, even outperforming stocks due to its strong rise immediately after 1970, following the end of the gold standard. However, if we change the starting point by just 10 years, for example beginning in 1980, the outcome looks completely different. Gold suddenly becomes the worst performer, while stocks move to the top. This shows how small changes in a time frame can have a big impact, making it very difficult to predict future performance. Another 10 years later, gold recovers some performance and ranks above long-term bonds again. In general, it is impossible to make accurate predictions. The only reasonable conclusion is that over long periods, stocks tend to perform best, though they can experience bad years, such as in the early 2000s. Long-term bonds are generally more predictable, though they can show some volatility during periods of changing interest rates. Even steadier are short-term bonds, which deliver modest but typically positive returns. Bond returns are overall the most predictable. Their performance closely reflects underlying interest rates. When examining the 10-year yield, we observe strong performance when interest rates are high and weaker performance when rates are low. Assets without interest rate or productive return, such as gold, silver, or Bitcoin, remain highly unpredictable. For this reason, most portfolios are balanced with stocks and bonds as the main components. Here are examples of how volatility and performance have behaved over the last 45 years for different combinations of global stocks and US long-term government bonds. In general, the higher the stock weight, the better the overall performance. However, the historical data also shows that stocks tend to gain value for a few years and then lose it again when crises arise. Only after 2013 did stocks begin to consistently outperform long-term bonds. This was mostly to the low interest rates during that period. The main reason was the excessive interventions by central banks in recent years, which pushed interest rates to historical low levels. In the comparison with short-term bonds, we see that stocks underperformed only during the first 6 years. After that, the performance gap between the two widened steadily, with a few setbacks during major crises. It is crucial to be cautious when buying bonds at times of such strong central bank intervention. A simple way to think about managing your money is to match your investments with time. Keep money you might need next month in the bank where it's safe and easily accessible. Money you might need within a year can go into short-term government bonds. Funds you won't touch for 1 to 5 years are better suited for long-term government bonds. Anything you're setting aside for 5 years or more should be invested in globally diversified stocks to benefit from long-term growth. And if you have some extra cash you're willing to risk, feel free to make speculative bets on things like precious metals, cryptocurrencies, or individual stocks, but only with money you can afford to lose. To illustrate this approach, let's look at a sample portfolio starting with $100,000. Following the allocation strategy above, we might hold $5,000 in cash in a bank account, $15,000 in short-term government bonds, $30,000 in long-term government bonds, $40,000 in a global stock ETF, and $10,000 in precious metals. The goal of this mix is to stay diversified across time horizons and asset types. If we track this portfolio over the 45 years from 1980 to today, we can compare its performance to inflation and the growth of the money supply. While there were years of negative returns, especially during periods of market crashes or rising interest rates, the portfolio recovered and, over time, outperformed both inflation and money supply growth, preserving and increasing purchasing power. For most smaller investors, the easiest way to invest in these assets is through exchange-traded funds, which offer diversification at low cost. The specific ETF you can buy will depend on the stock exchange or investment platform you use. We can categorize them into stocks ETFs, bond ETFs, and commodity ETCs. There are plenty of options, especially when it comes to stock ETFs. The simplest approach is to buy a single global stock ETF, such as MSCI World or FTSE All World, which includes hundreds or even thousands of companies around the globe. You can also diversify further by adding ETFs for specific regions or countries, such as MSCI USA, Europe, Japan, or emerging markets. Or by investing in ETFs focused on specific sectors like healthcare, semiconductors, and others. When it comes to government bonds, it is usually best to invest in bonds denominated in your own currency to avoid exchange rate risks. Most platforms offer straightforward bond ETFs, such as short-term options, often labeled with 0 to 1, or long-term government bond options, sometimes indicated with a year range, although many funds do not specify an exact maturity range. For commodities, investors often use ETCs, which stands for Exchange Traded Commodities. These are similar to ETFs, but are specifically designed to track the price of a single commodity rather than a basket of assets. Common examples include gold and silver ETCs. You will find similar ETFs offered by multiple providers, such as iShares, Amundi, Xtrackers, and others. You can explore and select ETFs and ETCs that suit your goals by using ETF search tools available on many financial websites. The important key takeaway is to stay aware of the current economic system and understand the most effective way to operate within it. These conditions can change over time and may require adjustments throughout the years. A broad diversification will always remain a reliable foundation for safety, but factors such as the monetary system, the level of globalization, and the degree of market freedom are all important considerations that may evolve and influence the best strategy. Thank you for watching. If you found this content interesting or learned something new, consider liking the video. If you have suggestions or topics you'd like to see covered, feel free to leave a comment. And if you want to stay informed, don't forget to subscribe.